Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron. The Fed's preferred inflation gauge, core PCE, rose about 0.3% in June, bringing the year-over-year figure to 2.8%, one of the hottest prints of the year. At the same time, consumer spending is stalling and bond yields are drifting lower as pressure builds on the Fed to deliver rate cuts. And meanwhile, the U.S. has entered a new phase in the evolution of digital finance, making its most significant move yet towards a regulated digital currency system. Now, the Genius Act is now law. It's the first federal statute to regulate stablecoins, requiring full reserve backing, limiting who can issue them, and opening up the door to a U.S.-backed digital dollars that could circulate globally. And it didn't happen overnight. The law followed months of closed-door talks in Washington and marks a turning point for both crypto industry and U.S. monetary strategy. Joining me now is one of the people in that room. Sergey Nazarov is a co-founder of Chainlink, a core infrastructure provider for digital assets, and he was directly involved in policy discussions that shaping the bill, briefing lawmakers and the White House directly throughout the development. Sergey, welcome to Kitco News. Good to see you.
Great to be here.
We got lots to get into. Before we do, let's zoom out a little bit and talk directly about this Genius Act. Obviously, it's now law. For our viewers, simply what is it and why does it matter here, Sergey?
So it basically makes the creation of stablecoins legal. It defines the conditions by which they need to be backed and by which that backing needs to be proven. And basically what this does is it opens the floodgates to the creation of stablecoins by large financial institutions and startups. It actually has two different tiers and does allow smaller financial firms to make their own stablecoins, technology firms, smaller companies, as well as large financial institutions to make their own stablecoins, and defines the disclosure and reporting regime, and basically creates a very clear and legal path to making stablecoins where that path didn't exist. This led to a few technology companies making the best stablecoins, such as Tether and Circle. But now what this does is it enables more technology companies to make their own stablecoins, and B, allows financial institutions to make their own stablecoins. So I foresee the amount of stablecoin value and basically tokenized cash going from about 200 billion to 2 trillion, so a 10x increase.
Yeah.
And I also foresee a lot of the world's largest financial institutions making their own stablecoins.
Interesting. Okay, so that breaks it down. I mean, for people who think in dollars or gold or even Bitcoin, I mean, what's actually changed? What can happen now that they couldn't happen before?
There is this on-chain economy of assets that exist on a blockchain. And so far, that on-chain economy has been represented by cryptocurrencies, which are often viewed as highly speculative. Many of them are tied basically to ideas, or in the case of NFTs, art. Now you're entering a world where the on-chain assets are now tied to real things. So there are now gold coins. Stable coins are essentially tokenized cash. You have tokenized funds. Now you have tokenized equities. I think you're going to see a trend in increased tokenization of commodities. And the reason that that's important is because this blockchain-based form of the equity or the commodity or the fund or the cash is actually a superior method for transacting in those things. It's superior for cost reasons, security reasons, efficiency reasons, risk reasons. And basically what you're going to see now is the vast majority of the commodity world, the equity world, the fund world, and the cash world going on chain, because that's the new place where all of these assets will be transacted against and owned and held.
Yeah, it's moving fast too. When we look at the act, I mean, one of the core rules is that stablecoins must be backed 1-to-1 with liquid reserves, mostly treasuries and cash. I mean, it sounds like a new kind of backdoor for financing U.S. debt. Is that what this really is?
I think that's one of the things that gave it a lot of force in the political side of this equation.
Right.
And I think that this became an important topic for DC when the total amount of U.S. Treasuries held by stablecoins as a group surpassed 0.5%. So before that point, stablecoins were not really an important political topic. But when you surpass a certain amount of the Treasury market, then the U.S. Treasury has to pay attention to you. And so the amount that the stablecoin group, an aggregate across all stablecoin holds, is somewhere between the country of Germany and Japan as of the last, key accounting of this at the end of last year.
Wow.
So it's a significant group, and it's actually a growing group also. And I know from talking to many lawmakers in DC that they prefer it in many cases to countries having US treasuries, because the countries can make a decision to go and sell their US treasuries in mass, depending on how much they have as a country. But if you're giving stable coins out to people and they're backed by US treasuries, you don't just have like one or two people in a country deciding to sell your treasuries. Now you have millions of people holding treasuries, and now you'd have to get millions of people to want to sell them, which in a certain sense creates a kind of buffer and stability to the treasuries market, which doesn't exist if you have, four countries owning the majority of US treasuries. Like that type of scenario, you basically have a very different game theory relationship with those countries because of their control over the treasury market.
Interesting. I wonder, what the structural shift will be with how global capital interacts with the dollar, if that's the case too.
I think cash on chain creates a group of buyers. So it creates a market. It creates the buy side of the market, which is always the more valuable and harder to create side of the market. And the more cash you have on chain, the more reason there is to tokenize an equity or a commodity or a fund, because the cash that can now buy your equity, commodity, or fund is greater. So if the amount of tokenized cash goes from 200 billion, which is the range it's in now, to 2 trillion, that means that the addressable market for tokenized equities, commodities, and funds 10x. And I think it'll go far past 2 trillion. So I think that the relationship of capital to those other tokenized things is going to be very heavily affected by the amount of on-chain cash, which is what a stable coin and a tokenized deposit and various other forms of on-chain cash are.
Yeah, that's interesting because JP Morgan's been sounding the alarm. They say that if there's a mass redemption, it could, trigger forced treasury sales and kind of spark instability. But it sounds like, one of the way to mitigate this is what you're saying is instead of countries or just these few people running it, people will be.
Yeah. So I think that I think that's a real thing, and I think that will continue to make stablecoins and on-chain tokenized cash attractive. Because it's a kind of decentralization of the risk of people taking action in the treasury market. So if you can decentralize, as the U.S. government, you can decentralize the risk away from large countries like China or others that you're worried about for a number of reasons, which there clearly are, and you can get U.S. treasuries in the hands of millions and millions and eventually billions of people, because stablecoins will become a preferred method of transacting, not only for financial products, but for day-to-day life. Now your market is these millions or billions of stablecoin holders,
right,
which in a certain sense is more decentralized and can lead to some greater stability, as long as there's faith in the US dollar and the US, kind of leadership in the world on various topics, depending on, how they perform on those topics.
Right. Yeah, it's been fun to watch. Even Jamie Dimon, who once blasted crypto, he was on CNBC saying that he's a believer in stablecoins if they're fully backed and regulated. Lou, let's play that clip.
When they say stablecoin, which we're going to have, I'm not against stablecoins, like a mutual fund, but mutual funds have rules. What are the rules going to be around stablecoins? And I think there are really, so I'm a believer in stablecoin, a believer in blockchain, not personally a believer in Bitcoin itself. But you're the customer. I don't like to tell customers what they can and can't do with their money. That is a whole different issue for us. And so we're going to accommodate those things. You mentioned that we did a deal with Coinbase, so you can now move money from Chase to Coinbase. We're going to make it easier for people. They've agreed how to use our APIs, which we think is a good thing. So we'll be in it, and we'll see. It's a little bit of a solution looking for a problem, because if I'm going to send you, we already have the JP Morgan coin. We already moved money 24/7. We moved $10 trillion a day quite effectively, efficiently, safely, with all the cyber protection and stuff like that. But if I'm going to send you a stable coin, you're going to say to me at one point, well, I don't want your mutual fund, just send me cash, and then I'll invest the way I want. But there are things that stablecoins maybe can do that traditional cash can't. Like is programmable. I might be able to send you a stablecoin, then you can send it to 10 different vendors you want to pay on a regular basis or something like that. So we'll be in it and we'll use it. And if the customers want to use it and how they use it and it's used properly, we'll be doing it. It's what the customer wants. It's not what JP Morgan personally wants.
So, Sergey, does that mark a turning point? Are we seeing full-scale institutional alignment now?
Yeah. I think we're seeing the impact of regulation making large institutions more comfortable to do these tokenization activities and stablecoin activities. I mean, this is what we've been talking about for years happening, and this being the last big hurdle to institutional adoption, which is the legal clarity for them to be able to safely participate in the on-chain economy, create stablecoins, create various forms of tokenized assets, tokenized equities, commodities, funds, depending on the institution. I think the institutions want to participate in the on-chain economy. I think they have a larger and larger growing user base that wants various on-chain capabilities, whether those are cash capabilities with stable coins, tokenized equities, tokenized commodities, tokenized funds.
Right.
I think they want access to all of this, and they're going to want it much more. And so the banks are going to service their customers. They're going to do what they have done for decades, and in some cases hundreds of years, is provide their client what their client wants, which I'm pretty convinced is going to be an on-chain tokenized equity, commodity, fund, cash, but on-chain, and that's what you're going to see, and the legal clarity that comes from clear and better regulation is gonna massively accelerate that. From my point of view, that was really the final hurdle into mainstream adoption, because I don't think the banks are going away. I don't think they're going to be completely replaced by a fintech or some amorphous kind of completely decentralized thing. I think they have a role to play in terms of having a client relationship, in terms of being regulated, in terms of having all kinds of key roles in institutional transactions. And now what's going to happen is they'll be able to do all of that in the on-chain economy, which is where they'll interact with smart contracts, they'll interact with Oracle networks and the data, identity, and connectivity that Chainlink provides. This is where things are heading.
Interesting. I got to ask you about geopolitical, because obviously, I've been doing some research, and Sergey, you've been everywhere. You've been talking to all the central banks. I mean, you've been in these rooms. I know former China central bank governor called it, this was kind of a digital dollar offensive. And then we heard from the ECB president, Christine Lagarde, urging Europe to kind of respond. Do you think the Genius Act is kind of the starting shot of a new currency war?
I don't think it's a currency war. I think it's the competitive dynamics that commercial and central banks face about being relevant for the next generation of the financial system. So I think what's happening is also what we've said many times in the past, which is that these commercial institutions, and in some cases the central banks, are competitive by nature, in that they want, in the case of a central bank, their economy to grow. In the case of a commercial bank, their market share to grow. And the degree to which blockchain technology, the on-chain economy, stablecoins, tokenized equities, tokenized funds, tokenized commodities enable that market share growth and them to compete, then they'll adopt it pretty rapidly, as long as there's no huge risk or huge compliance issue or huge legal cost from non-compliance. So now the legal issue and the cost of non-compliance is being removed, and it's happening to the point, to your point, that the central banks are also now wondering, if I don't allow my ecosystem to be able to transact in stable coins, to be able to generate stable coins, to be able to generate tokenized equities, commodities, and funds, then will my economy suffer? And that is a very clear sign that we've kind of passed the point of no return now.
Right.
We in the blockchain industry, being believers in the technology and its benefits for clearing and settlement, for data, for compliance, for reliability, for security, for self-sovereign identity and ownership, have been big believers for a long time. And so I personally and others have used the word inevitable a number of times. But now I think we are truly past the point of no return, because the governments themselves now see that their economy needs to be upgraded, their financial system needs to be upgraded, and that is kind of the point at which I think you start to get mass societal adoption, at least on certain dimensions of blockchain technology and Oracle networks and smart contracts, basically powering their financial system.
Right. Yeah, it's fascinating. I mean, it almost sounded like, by a couple of those statements, it's almost like FOMO, right? Bottom line, I mean, who's first? Who's number one in the race right now? Is America kind of leading the world in digital currency infrastructure, or are others ahead?
America is not in the lead right now.
Yeah.
Right now, I would say Singapore, Hong Kong are pretty much still in the lead in terms of the guidance they've provided. Dubai is not that far behind them. And with the Stablecoin Act, the U.S. has created a lot of clarity on stablecoins. They haven't created clarity on securities, commodities, funds, and all these other financial products. That's through something called the Clarity Act, and there's another version of that now in the Senate with the Senate Banking and Finance Committee, who we're in conversations with and thinking through how to provide some guidance to make that bill better, in addition to other bills that are now coming up in the Senate and the House. But once the U.S. passes Clarity and whatever the Senate version of that is, then you will have created clarity on these other dimensions of tokenization. Right. So once you have clarity on stablecoins, and once you have clarity on the tokenization of securities, commodities, funds, and other financial structures, then I would say the U.S. will be on par with the rest of the world. I do have to say, though, that the speed at which the U.S. is making these changes is truly immense, right? So I've worked with governments now for many years, have visited and spent time with many central banks, have discussed these key priorities that they have around digital assets with many of their teams, have met with bank governor, have discussed these things. And so what you basically arrive at is that governments don't move very quickly. But in this case, the United States is moving extremely quickly for a government. So I am very positive on the idea that the U.S. will be able to get to on par with these other jurisdictions, and then if it continues at this speed, it'll be able to surpass them relatively quickly. And that actually has very big consequences, because then the rest of the jurisdictions that want to transact with the U.S. financial system, which is basically all jurisdictions, will have to catch up to the U.S. So the U.S. would kind of pull them along in terms of regulation and innovation on regulation. And then the second big thing is that the U.S. market is the largest domestic financial market, and so you have this huge force that's going to flow into the stablecoin world, the tokenized fund, the tokenized equity, the tokenized commodity world. And if that can happen at the speeds that it seems to be happening, then the U.S. will be ahead. I can see the U.S. being ahead by the end of this year or by the middle of next year, if things continue at the rate that they're going. Yeah, sorry. And also just want to mention that's thanks in no small part to the Trump administration and their great work on reversing the previous mistakes towards our industry and really supporting our industry now in a way that it has been hoping for and needing for a long time. So I think our entire industry should be really grateful to the Senate, the Congress, and especially to President Trump and the Trump administration for their immense support. That's having a huge impact on our industry's growth.
Yeah, I got to ask you more about those meetings, including, while you were meeting with the president. But before we do that, I mean, some countries are now kind of exploring this gold or commodity-backed stablecoins to counter this dollar dominance. Could we be entering a dual reserve era? One side digital treasuries and other tokenized hard assets?
So the thing I direct your attention to here would be that it's not called a US dollar coin.
Right.
It's called a stable coin. And so the initial idea of stable coins from the early days of the blockchain world was actually a multi-collateral stable coin. So a stable coin that is backed by a mix of assets. The Libra stablecoin from Facebook also had a similar idea, which is, I think, one of the reasons it didn't continue. And it is called a stablecoin. It's not called a cash coin. It's not called fiat coin. It's not called US dollar or euro coin. It's called stable. And so the fundamental idea of a stablecoin is that you have a currency that's stable in that it retains purchasing power. There is now more and more interesting versions of stablecoins that not only give you purchasing power, stability, like inflation resistance, but they give you yield. So they provide you the yield from the treasuries backing the stablecoin. So, you kind of have a currency, but the currency is paying you interest. So kind of replaces your need for a bank account and the counterparty relationship with the bank, which is interesting. And really where I think we arrive with all this is there's different stable coins and different tokenized assets denominated in different stable coins. We've already worked on multiple implementations where you have a stable coin backed by one set of treasuries or currencies or single currency that's converted into another stable coin, because that second stable coin is what the tokenized fund equity or commodity is denominated in, right? That's what you need to buy it in. So I do think there will be competition for stablecoin adoption in the on-chain economy, but the U.S. is very far ahead on that. I mean, the U.S. is still at well past 90% of stablecoin usage, and I think the U.S. kind of woke up just in time to the value of this, and they stopped this highly aggressive and predatory approach towards our industry and stablecoins, and now they're embracing stablecoins and this trend of tokenization and real world assets in general. So I think the U.S. and the U.S. dollar in the stablecoin market right now is on the best trajectory it's ever been, right? Because the trajectory before was you have the market share, but the people who hold the underlying asset don't want you to exist. Yeah. So are they gonna snuff you out of existence? Yeah. But now you have the market share and you have the people that hold the underlying asset, the U.S. Treasury, encouraging the success of this essentially format for holding a U.S. Treasury and cash and the U.S. dollar or tokenized deposits. And so for me right now, this is the best trajectory the U.S. dollar has ever been on for global dominance and adoption in the on-chain economy. And once again, that's in no small part, and in large part, actually, even thanks to President Trump, his administration, the relevant senators, the relevant great congressmen that have pushed that forward, and of course, the technology companies, stablecoin providers, and the infrastructure companies like us at Chainlink that power a lot of these stablecoins.
Let's bring gold into the picture. I mean, central banks and institutions are tokenizing gold reserves. We've seen it. I mean, we know that Tether has that gold-backed coin as well. Chainlink helped tokenize a major institutional gold vault recently, no? I mean, what's that process look like, and is it scalable?
Yeah, we've been involved in tokenizing gold, and we're continuing to see more of that and work with tokenization efforts around gold, including with some of the folks you mentioned and others. At the end of the day, I think where we're going to arrive is you're going to have all kinds of tokenized commodities in addition to gold. And the most interesting thing to me, actually, is going to be yield on gold. So if you want to talk about the future of gold in the on-chain economy, one of the things that's the most problematic with gold and that makes it the least competitive with other financial products and stores of wealth is the lack of yield, right? If you have money in gold, no one's going to pay you yield on that in the current financial system. Now, in the on-chain economy, thanks to the innovation of DeFi, decentralized finance, thanks to all the interconnected markets that exist there, I have seen, and I think we'll continue to see, tokenized gold being able to generate interest, so yield. And I think that can put tokenized gold in a completely different place from where it historically has been, because historically when you buy gold, you're assuming that either through inflation of the dollar or political instability or the scarcity of gold or whatever set of ideas you have about gold, that the annual increase in its value will surpass the yield that you could have made on having that dollar in a treasury, which is tougher and tougher when the yield is at 4 or 5%. But imagine if you could have gold, tokenized gold, but you could get 1 or 2% yield, or maybe even 3, or maybe even similar yield to U.S. Treasuries because of decentralized finance, repackaging of the gold, the ability to use it as collateral in various places, lend it as collateral for various things, things that haven't even been created yet. But I think that that's when the gold community is going to really wake up to the blockchains, is when you can hold traditional gold in some kind of counterparty relationship with an exchange or a custodian or somewhere, or you can hold tokenized gold, which you actually have more control over, and which you can have a yield on. So I think that's gonna really blow people's minds, and all the people that weren't so big on Bitcoin and blockchain technology from the gold community, at that point, once they see that value, are gonna change their tune pretty quick.
Yeah, I mean, it feels like it's a structural shift. I mean, does programmable yield-bearing gold, change the role it plays in global reserves? Could it challenge fiat debt as a preferred kind of sovereign asset?
Yeah, maybe. I think on a commercial level, it could do that. On a central bank level, I think that's tougher. I mean, there's a reason that there isn't yield on gold currently. It's because of what you can use that gold for. But the DeFi community is extremely creative. Right now, Chainlink powers the majority of the DeFi community. On many chains like Ethereum, we power the vast majority of it at over 80%. So we know that community really well. We were there, helping it grow from less than 100 million in total value to over 200 billion now, continuing to power the majority of it. We know the teams and the people there very well. They're very creative people. They're very smart. They're very motivated. They've found unique ways to create yield on various asset types, and how to use those assets for collateral in various systems and financial kind of products that manage risk well while also creating a lot of yield. And that is where I think this will come from. I'm not sure it's going to come from the traditional finance world's tokenization of gold. I think it'll come from the decentralized finance communities' ability to generate yield, which is a skill they've developed to like an amazing degree now. And I think it's going to be something that they're continually seen as doing well.
Okay.
And so they're going to become a larger and larger source of yield.
Yeah, wild to think that that's an opportunity for folks. When we're talking about, getting back to the Genius Act, I have to ask you, I mean, obviously a major concern for many in our audience is state overreach and surveillance. Does the Genius Act bring us closer to a system of programmable surveilled money? I think there was a caveat in there for CBDCs, no?
Yeah, so there's no CBDCs in the U.S.
Yeah.
The U.S. is not going to go with CBDCs. I think there's a lot of Republican outcry against CBDCs. I think it's viewed as a form of government overreach and government control when you would have a centralized account as an individual at a central bank. And so there's a fear that if there's a political will, or if there's a political administration in power and you disagree with them, that from the central bank level, they could control all your assets or your money or your bank account. Now, realistically, I think we've seen a lot of people get debanked. I think we've seen a number of banks refuse to give people accounts. I think you've seen banks bend to the political will of most governments, but it is not necessarily the same as a central bank having direct and immediate control over an individual's personal bank account on a 1-second basis, right? So I think central bank digital currency is not going to be something that comes around anytime too soon in the US. In other countries, it is something that we work on with various central banks. There's also very different forms of central bank digital currency, which is what not everyone understands still. There is wholesale central bank digital currency, where you basically have a central bank creating a relationship with commercial banks, and then the commercial banks, keep their accounts in the CBDC with the central bank. You have a retail CBDC, which is what I just described, where the central bank directly controls private individuals' accounts. You have a few variations in between. There are a number of countries that are going to go with CBDCs, but fundamentally, whether you have CBDCs, whether you have privately issued stable coins, it doesn't really matter from the point of view of the on-chain economy, in my opinion, because what you can actually do in the vast majority of on-chain assets is wrap them. So you can take an on-chain asset and you can wrap it and make a derivative of it, kind of, and then use that. So basically, whether you have an on-chain CBDC or you have an on-chain stablecoin or an on-chain tokenized deposit, I think all of those will be viewed, pretty close to each other in terms of their utility, their usability. Some of them might have different risk scores depending on who the issuer of the stablecoin is, who the tokenized deposit, issuer was, and how that works, what that's backed by.
Right.
But really, if there are CBDCs, I think a lot of them are going to get wrapped and repackaged into other things, and then those things will flow through the financial ecosystem.
Yeah, because if issuers or infrastructure providers can freeze accounts or follow political directives, how is it different from a CBDC? Could Americans still be debanked in this system just through private hands instead of government?
With stablecoins, they shouldn't be, no.
Yeah.
And you'll have a lot of choice about which stablecoin you want and whether that stablecoin is backed by assets from one custodian or another. So you'll have stablecoins that you can acquire that hold U.S. Treasuries, but it could be a smaller financial institution, could be a financial institution offshore in Singapore or somewhere else. So the stablecoin approach definitely creates a greater degree of decentralization. And you have a lot of choice, and you can evaluate the risk of your stablecoin provider that you get the stablecoin from. And that's actually where Chainlink comes in, because we are the largest source of proof of reserves, proving what the underlying assets of this backing the stablecoin are. We also have proof of liabilities, proof of solvency, these various other proof of systems that we're in the process of thinking through and rolling out, where we really want to get to a place where you, as a consumer of stablecoins, can immediately assess, and on an ongoing basis, in an automated way, assess what the reliability and the risks of the stablecoin are. And that includes the custody risks, what the underlying asset is, the risks of the custodian, and if they're solvent or not. And all of these risks in our world, in the Chainlink powered world, would also go on chain. So now you would be able to look at a stablecoin and you would see the stablecoin represents a single US dollar or a basket of goods, and you would see that on-chain representation of value has a number of parameters about it, such as that this stablecoin is backed one-to-one with the US dollar under these regulations in this custodian. And then you would be able to know some more things about the custodian, and then you would be able to know some other risks. And what our system does is it updates those risks for that stablecoin automatically. So the failure and fraud scenarios in the financial world are usually due to a gap in understanding what's going on with an asset or a counterparty. And what we've done for these stablecoins and other assets is we've closed that gap to a few seconds, so that you can immediately know if the reserves backing your stablecoin are below the levels they need to be, or even approaching those levels. And then you can write an automated system that will exchange a lower risk, a higher risk stablecoin for a low risk stablecoin. If those properties change, and that won't be based on a person making a decision. That'll be a smart contract that you have assigned certain rights to your stablecoin for. So you can have like a risk rebalancing contract that will look at proof of reserves, proof of solvency, proof of liabilities. And if it goes below a certain level, you can rebalance into another stablecoin and not be exposed to those changing risks. And by the way, you're not realizing this after like a year of an annual auditing firm. You're getting this information essentially second by second, effectively real time.
I got to ask you, I mean, you're kind of talking about this on theme, right? I mean, you've long warned that oracles are a systemic vulnerability. If corrupted data enters a sovereign system, obviously whether for central bank or tokenized gold, the consequences could be massive. How does Chainlink prevent that at a sovereign level?
So there's a number of different approaches. The most common approach is decentralization. So there's a number of independent nodes that are selected and connected to the data sources, and they verify the data and they come to what's known as consensus. So essentially a kind of technical agreement that the data is correct. So Chainlink provides a framework and a set of nodes and infrastructures and protocols to create this consensus, to verify things, to verify that the data is correct, that the assets are there, that the world is as we're being told it is. In this sense, Chainlink acts as a kind of truth machine verifying things about the world. There are other ways to verify this information. In some cases, the information is only available from a single source. And in those cases, you're basically dependent on that single source of information. What the Chainlink community and the Chainlink system does at that point is it clarifies that risk. So it makes it clear that this information is coming from this place. And if you look on the data.chain.link dashboard, you'll see certain call outs and even warning labels about that data for proof of reserves or other data feeds might come from a single source. In those cases, you really can't do anything because there's a single holder of the data, and all you can do is inform people of the relevant risks. And then you can do things to make sure that the data source, like the custody provider, you can check other things about them, like their credit rating and other things, to make sure that they as a single source are still solvent and reliable, which can be an additional source of data, but not the same data as the actual reserves. So we've thought pretty deeply about this, but there's only so much you can do at some point.
Yeah, no, I hear you on that. I also have to ask you, I mean, you've confirmed that Chainlink CCIP, for the viewers, I kind of think of CCIP as kind of a SWIFT for blockchains, if you will. It's being tested internationally, no, Sergey? I mean, can you name any of the jurisdictions or agencies currently kind of piloting it?
Yeah, we have a lot of stuff going on with CCIP right now, internationally, cross-border. We've done things with the Brazil central banks and a number of other central banks at the central bank level. We've now done transactions from Australia to Singapore. Those transactions actually had privacy, and CCIP is basically like the TCP/IP of blockchains. So it's the system that connects all the blockchains to each other for data transfer and value transfer. And basically what you arrive at is a world where you have many different blockchains, thousands of blockchains, and they all have liquidity and value inside of them. And it could be a central bank chain, it could be a private bank chain, it could be a finance technology company chain, it could be a public blockchain with a number of different applications. And each of these blockchains has a stable coin user base on it, or a CBDC user base, or a tokenized deposit, or some kind of user base that has private keys with assets that can be used to buy other assets. And so the challenge then becomes, how do you get all of this highly fragmented liquidity that sits in all these different chains, whether it's a central bank chain, a private institutional chain, a public chain, a fintech chain? How do you get all those chains to be able to transact across each other? Right. And to your point, how do you do that in a way that complies with the different regulations of the different places where the chains are, right? So how do you get a central bank chain from Brazil to transact with a central bank chain from Hong Kong? Right. How do you get an Australian private bank to transact with a Hong Kong dollar denominated tokenized fund? That's something we actually did with ANZ Bank, the second largest bank in Australia, and Fidelity International. And so we've done a lot of these transactions now. We've worked through them in detail. at different levels with the central bankers, the regulators, the private banks, the funds, and we are seeing an increase in the amount of interest and the amount of activity, especially for these cross-border transactions, whether they're payment transactions, whether they're asset settlement transactions, and I just see much more of that.
Yeah, interesting. Our time always goes too fast. I could spend hours with you. I guess to kind of wrap it up, I'll ask you a follow-up on this. I mean, are these governments kind of looking to use Chainlink as critical infrastructure, not just for stablecoins, but for sovereign data, settlement, or even digital identity? I'm curious if your infrastructure is going to be used for the U.S. government. I mean, could you be the pipes behind this new system?
I mean, that's definitely what I and our community are working towards.
Right.
We're very active in DC. We've already worked with many central banks on getting them access to CCIP. We've built various features that make it more attractive to them. Our community has built a lot of great resources for those central banks to adopt it. I think you'll be seeing more and more adoption by large multinational banks and asset managers of CCIP. And I think what you'll also see is that it's not just CCIP, it's actually the Chainlink data and the Chainlink compliance standard. So Chainlink is really a collection of standards that are then used to build transactions. And when you build the transactions, they have a few components. They have a data component, they have a connectivity component, that's CCIP. They have a compliance component, that's where we have the automated compliance engine system. In that system, you have something called CCID, which is cross-chain identity to your identity point. So Chainlink is not just a provider of data, and it's not just a provider of connectivity across chains. It's not just a provider of connectivity to SWIFT, which is someone we've been working with now for many years for off-chain payments and integrations. We are also we're basically a platform. We're a set of standards and platform for these governments to create clarity for their banking system about here's how you prove the value of an asset. Here's how you move that asset. Here's how you create compliance and identity around that asset. Here's how you create reporting back to me, the government and the regulator, around that asset. And Chainlink right now is the only platform that can successfully create all of that for a transaction end to end. It's the only one, right? Right now, there are other platforms that try to provide data or connectivity. There's no one really providing identity in any real relative quality. Mm-hmm. But Chainlink is the only one providing all of these in a single system.
Hey, Sergey, I'm going to give you a second to cough there. We've been chatting for a minute. My last question to you, though, is kind of to our traditional investor audience, the ones that are gold bugs, especially these, gold holders. I mean, how should they think about capital, custody, and obviously financial freedom in this new digital framework? What would you say to them who's, kind of worried about what this is going to come to in this digital world?
I mean, I would say that they should look at on-chain tokenized assets excuse me, as a superior form of ownership, as a superior source of risk managed yield. And I would tell them to look at the systems and the infrastructures that are going to be powering this huge shift. So there is going to be a huge shift now in the global financial system, in the retail community, in the asset management community. Basically, all of these financially focused communities all over the world, banking, asset management, retail, all of it, will be shifting onto this new set of rails, new set of standards, new set of tokenized asset and forms of ownership. And so there's really two things to consider there. One thing is, what are the infrastructures and systems that are going to lead that transition? And the second one is, what are the financial products that you get access to, like yield-bearing gold, right, like yield-generating stablecoins, like better forms of funds in tokenized form, where you could use the fund for collateral as an investor in ways that you couldn't use a traditional fund as collateral. So it's really these questions that are quite important.
Fascinating. I know we have the CEO of Tether coming up on this show fairly soon. We'll be asking about the gold-backed as well. Appreciate your time, Sergey Nazarov, co-founder of Chainlink. Thanks again for joining us and sharing your insight during such a pivotal moment for digital infrastructure. And it seems like global finance. Good luck with everything.
My pleasure. Thank you.
Thanks, Sergey. We'll have you on soon. Appreciate your time. And of course, to our audience, if you're new here, subscribe for more exclusive interviews, market intelligence, and critical analysis. And to our long-term subscribers, thank you for being a part of the Kitco community. I'm Jeremy Szafron. We'll see you next time.